Okay, so depreciation has a specific meaning in accounting, in particular financial accounting, and that meaning, depreciation is a systematic reduction of the value of a tangible asset over its useful life. Okay, so that's a specific definition, but let's try and flesh out precisely what we mean by that in an example. So in this example, we have company Z, and they've just purchased new machinery. Now, new machinery, that's classified as a non-current tangible asset. So they've made this purchase, and this new machinery has cost them £300,000. Now, one way to record that in the accounts would be as follows. So you would have the company's revenue for year one. So let's say in year one, the company has made revenue of £500,000. That's roughly about what they're expecting to make. It's a slight increase on the previous year. So that's about that's a reasonable amount of revenue for this particular company. Now in the year, because they bought the machinery in year one, they're also going to put the cost of buying that machinery, because spending money on a machine, that's quite a lot of money, and it's an expense, it's cash outflow. So we're going to include that in the costs. There are the other expenses of running a business, the administrative expenses, the cost of goods sold, etc. So we're going to include those as well. So when we've taken these amounts from our revenue, we get our profit or loss from the year. And in this case, it's a loss of £50,000, primarily because we've included the cost of the machinery. Okay, so let's look at what happens in year two if we use this method. So in year two, revenues have increased slightly. They've gone up by £10,000 in accordance with what was estimated, so that's fine. Now, we bought the machinery in year one, and we costed or expensed the entire amount of that in year one. So there's no cost associated with year two. And we've got our other expenses, which again are just a slight increase on the year before. So these are sort of in line. And in this case, we end up with a profit of nearly £250,000. Now, the issue with that is that it's a massive difference from year one, where we saw a loss of £50,000. Now, to go from a loss of £50,000 to a profit of nearly £250,000, that's going to suggest to the shareholders or people looking at the financial statements that something significant has changed at the company, where in reality, all that's changed is some machinery was bought in year one. Now, this way of recording expenses relating to the purchase of non-current assets isn't really a very accurate or realistic way of doing things, because when you buy machinery, you have it for a number of years. That's part of its classification as a non-current asset. You might have it for 5, 10 or 20 years. And the idea then with that expense is to spread that cost over the useful years of the use of that asset. So in this case, what we have to introduce is something called depreciation. And depreciation is the annual cost of the asset based on its initial value divided by its useful life. So in this case, we take the exact same scenario. Company Z have bought new machinery, but instead of costing it all in the first year as new machinery, we are going to divide it by 4. So we expect that asset to be used for 4 years. And so each year we will charge 1/4 of that full amount as a depreciation charge. And that's going to give us a more steady, sort of predictable charge in the accounts each year. So you can see in this first year, numbers are the same, the £500,000 of revenue, £250,000 of other costs. That's the same as what we had here. What's changed is the depreciation is 1/4 of the full amount, because we're splitting it over 4 years, and that's going to give us a profit or loss, in this case a profit of £175,000. We repeat the same thing in year two. So revenue has gone up slightly, so have other costs. Depreciation has stayed the same, because it's just that same amount divided by 4, and the profit or loss went down by a small amount in this case because cost increased at a faster rate than revenue. Now in this case, you can see from year one to year two, we get a much better representation of what's going on in the company, that slight decrease in profit rather than a massive change from a loss of 50,000 to a profit of nearly 250,000. This is useless information. This is useful information. It's more accurate and more representative of what's really going on. And we continue this throughout the useful life of the asset. So again, charging 75,000 of depreciation each year, and we see a slow increase in profits. And this is more in line with what you would expect to see in a company's accounts. So this is kind of the theory behind why we use depreciation. We're just splitting the cost of an asset over its useful life. That's really all it means.
So if you found that video helpful, remember to like and subscribe on YouTube to make sure you're getting all the latest Astranti updates. And you can also find us on other social media platforms. We are on Twitter and on Instagram, and you can find us on Facebook in a number of different places. We have groups for operational strategic management case studies. So have a look on Facebook and see if you can find the right group for you.